Let me set up the screen share here real fast, and we'll get going. And so going to cover a lot of topics today. I work on multiple screens, so sometimes I bounce around, but I work multiple, anyway, naturally I get a spam call right in the middle of this. Uh, as you can tell, I've been doing it a while. Actually, it's a little bit longer than 25 years. I just hate saying it. At 43 years now, and I kind of work for myself. I don't work for a bank, so I'm not going to give you a bank opinion. I'm going to give you my opinions, and that means I'm a little freer to say things. I'm not pushing a product. I don't have a dog in the fight. And I think that's important because that gives me a little bit better way to guide you to where you need to go or help prepare you to where you need to go. And I think that's really what's important here. Let's go on to the next one here. So we have a lending landscape today that has many players in it, and some are banks, some are non-banks, some are regulated, some are not regulated, and it makes a difference. We have the big banks, which are more of a factory setting, I'll call it. We have the regional or community banks, which are a little more personal. We have credit unions in the mix trying to get into business lending, and they're also interesting because they're trying it, and they have some advantages too. We'll talk about that. Fintech, non-bank lenders coming on strong. They can act quickly. They don't have the regulations, but a lot of their solutions are going to be a little bit higher in price, and so you got to think about what's the fit for you. So really let's start off what we're talking about today in terms of financing. The conventional loan types, which you see on the screen, which are the common loan types, are the term loans, lines of credit, generally used for working capital, and equipment financing. They're very familiar to people. And in term loans, you also would include real estate financing. So they're very familiar, have decent rates, and I won't mention rates specifically today. I'm going to talk about what goes into them so you know what to negotiate, but each institution is a little bit different, so it's hard to really specify rates. But the cons of conventional financing sometimes is it's harder to qualify and can be restrictive without a relationship. As I said, the big banks take more of a factory approach. When you put the application, it is going to be credit scored. It is typically, especially the lines of credit for small businesses, it's like a giant credit card. Here's your checkbook. We'll see you in a year. And as long as you don't trip something up on our credit monitoring, which is something like monitoring your personal credit report or DMB or something like that, we're really not going to talk to you. It's not really relationship lending. For a lot of people, that can be very advantageous because it's just no bank interference. Smaller banks, well, they are going to be a little bit more intrusive. They're going to take and ask more questions. They're going to require a little more paperwork, but their solutions are generally going to be more customized to your business. They're going to want to know what's going on, either quarterly, monthly reporting, but they're going to be more relationship oriented. And so by getting that information, one of the benefits is that it generally sets you up in case you need it sets you up for other loan requirements, other loan requests, is what I'm trying to say. And it really helps you set for success down the road. It's not just today, it's tomorrow as well. And very quickly, one of the other types of financing that you'll see a lot of, and I'll mention it, is SBA loans. SBA is a very popular type, Small Business Administration. It is a government program. The banks get their loan guaranteed. 75, 80% of the loan is guaranteed by the federal government. So the banks are taking lower risk. It is designed for the business that can't qualify for conventional financing. In real estate, it's actually been really a good program with a 504, and I'll explain that in a second, but it requires a low down payment. So there's a couple different programs in SBA. There's 7A, that's the typical, we're going to give you a term loan, you can acquire a business, a little bit longer terms, sometimes up to 10-year terms, where a conventional loan might be 5, maybe a little bit more in fees, a little more paperwork. There's the 504, which is very popular for owner-occupied financing in real estate. Reason is that the 504 consists of 2 loans. There's a first from the conventional bank, which is up to generally around 50% loan to value, let's say. There's a second, which is provided by a community development corporation. Those are lenders formed by the SBA, blessed by the SBA, who do a second, thereby taking some of the risk away from the first because they come in behind it. And in case of a foreclosure, the second would have to keep the first current. And they're about 40% loan to value. And the remaining 10% comes from you in cash. The SBA Express mentioned here is more for really micro business, small loans under 300,000. They just changed the limit. So I think it's 350,000. And they're good for just the quick business acquisition, sole practitioners, small businesses, and they're supposed to be a little more liberal. Again, that's going to depend on the institution. They're a little harder to find the banks that will do them, but they're out there. They're done by fintechs as well. But the 504 is one of the more popular ways to go. It, like I say, it does the 50, 40, 10. It also has a 10-year bullet on a minimum 20-year amortization. Conventional real estate lending, a lot of times like 5 and 7 year bullets. I can tell you right now, and a bullet by me is that is a balloon payment that comes due in 10. It may still have 10 more years to be paid down, but it comes down to a balloon, and you have to pay the balloon off. Right now, the thought is when you're going out getting real estate financing is that you're never really going to make it to the balloon. The rate environment at some point will change, and you're probably looking at a refinance, or for a lot of businesses, they get to a bigger building, they do another financing, sell the building they're currently in, and then they go on to the next loan. But it's to the lender, they use it as a risk mitigation tool. The shorter the term, the more they get you to the table, the more they're able to evaluate what's going on. And the perception is that they'll be minimizing or lowering their risk. And besides banks, there's some alternative financing options. And these tend to be more collateral based. The asset-based lending mentioned there is more based off your receivables. They take a percentage of your receivables. So in essence, they're kind of buying your receivables. And they are going to control the flow of funds in and out. You're going to generally use a lockbox